This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
Onward and upward. New highs for stocks, new optimism for small business, and less debt for American households. Are the pieces in place for more market gains?
Supply shock. Oil production in North America grows at a record pace. What it means for jobs, the environment, geopolitics, and the price you'll pay at the pump.
And the comeback kid, how Yahoo went from being an internet darling to a dinosaur and back again. We have all that and more tonight on Nightly Business Report for Tuesday, May 14th. Good evening, everyone. What an incredible rally. It just is, Tyler, a rally that doesn't want to quit.
It does not want to quit. Rainy days and Mondays may always get you down. I know, I date myself, but count on Tuesdays to get you up if you're a stock market investor. Today was the 18th consecutive Tuesday the Dow has gained, this time finishing at yet another all-time high. All but 4 of the Dow 30 finished higher today, led by Bank of America, up nearly 3%. Contributing to those gains, greater optimism about the economy from a small business group, and then encouraging words about stocks from David Tepper, co-founder and owner of the hedge fund Appaloosa Management. Here's why he and a growing chorus of investors are bullish on stocks.
The economy's getting better. Autos are better. Housing's better. It continues to improve. They can't find enough people to work in housing. It's the only thing holding it back right now. We have years to run an early stage economy. We don't have inflation. You have capacity utilization is low, so you have room there. Labor unemployment's high, so you have room there. There's no inflation on the horizon, so we have a little bit of room to run.
And a run they did today. The blue chip Dow rose 123 points, closing at that new record of 15,215. The Nasdaq added 23 points, and the S&P 500 was up 16, also reaching a record close, with 75 of its constituent companies posting all-time highs today.
Joining us now with his take on where the market goes from here, Sean Darby. He's Global Head of Equity Strategy at Jefferies. Sean, let me add to the numbers of statistics that Tyler just mentioned. 178 days that the S&P has been up without anything more than a 5% correction. So does this mean that it's time for a correction, or maybe not?
Well, the equity market breadth has been superb, and that really represents the fact that there's been ongoing buying power across the board of the stocks in the US. And ironically, the stocks that have been favored the most by investors have been very defensive. So defensive markets by their nature don't necessarily correct that much. And really what I think we're starting to see now in the equity market is quite a rotation into more real economy issues as people become much more confident about the next 12 months in the US. So I suspect we'll continue to make new highs, and that will grind higher as people capitulate into much more riskier parts of the economy.
Sean, I was speaking earlier today to Andrew Sliman of J.P. Morgan, and he mentioned that he thinks that the dividend stock trade has gotten very crowded as investors have poured money into that particular category of the market. Do you agree with that?
Well, I do. Unfortunately, the evidence that we see from the fixed income market is that that trend can go on for a lot longer. And last week, for example, we saw a very, very, over 7 billion going into fixed income and credit into the US, which is a 2.5-year high. So unfortunately, I do agree with the statement, but the trend is likely still to be into that area until rates start to move up. But I think that the overall tone really for the US in the next 12 months is real economy beneficiaries, and particularly stocks benefiting from a domestic backdrop rather than international growth.
You know, I want to get back to this correction or a pullback, because a lot of people are bracing for that other shoe to drop. What would be the trigger? I mean, what are the warning signs?
Well, I think the warning sign would be higher bond yields in the US. I think we're starting to see that certainly in Japan, which is now recognizing that the BOJ's policies have been very aggressive and that they're beginning to be worried about inflation. And I think that certainly if the US started to see any inflation picking up or indeed much better job growth numbers, the backup or the push up in bond yields in the US would start to hurt the market gains in equities. But I still think that will probably be more of a 2014 story rather than over the next couple of months.
Tell me quickly how you see the balance of supply and demand in the equity market. We've had a lot of stock buybacks out there and money in the form of the Federal Reserve and elsewhere coming into the market. Does that force prices higher, all things else being equal?
Well, I think it does, and I think we've been doing quite a bit of work on this over the last 12 months, and the share buybacks have also been accompanied by a very, very scarce amount of new equity issuance. So this money's been forced into equities, it's been forced into very, very defensive areas where the people have been chasing yield, and now, of course, that people have to rotate into much more sort of riskier parts. And of course, unfortunately, the supply has been shrinking at the same time. So it's all been a very, very strong pulse for the equity market, and I think we'll still be seeing gains going into towards the end of the year.
Well, that's a very upbeat way to end this conversation. Thanks so much, Sean. Sean Darby of Jeffries and Company.
Well, here's something you might not expect to hear out of Washington. The budget deficit this year will be smaller, a lot smaller. New figures from the Congressional Budget Office predict that this year's federal budget deficit will be $642 billion. That's down more than $200 billion from the estimate in February. So why the change? Well, spending cuts are one thing, higher tax revenues, in part from a healthier economy, are another, and more companies are paying back Uncle Sam for their bailout loans.
Well, it's not just the government getting into better financial shape, but so are the rest of us. New statistics from the Federal Reserve show that Americans are doing a lot less borrowing these days. Hampton Pearson has more on what that lower debt load means for the economy.
In the first 3 months of this year, Americans lightened their household balance sheets by about $110 billion, according to the New York Federal Reserve. Debt payments increased and delinquency rates fell across the board on everything from home mortgages, home equity loans, and credit cards. People like Bradford Elder, who's been on a self-described financial diet of less revolving credit.
Well, as the economy improves, I think that people are much more cognizant of the amount of debt they're taking on. What kind of debt it is it risky debt? Is it revolving credit card debt? So I think the awareness of the problem has increased.
Student loan debt bucked the trend, rising to $986 billion, an all-time record. Among those paying the price, Kendra Clayton. She's working full-time, attending law school at night with the debt burden to match.
And debt's not something that I really look forward to, especially being a law student. Times are tough right now, so you definitely want to think very smartly before you go back to school.
Total debt topped $11.2 trillion in the first quarter of this year, down from the $12.7 trillion peak in the third quarter of 2008 during the financial crisis. Leading economists say it is part of the reality check for consumers, who know banks now have tightened their credit standards.
If you go back to the pre-bubble years when everyone was getting credit cards all over the place, they don't have that anymore. They have lower limits. So to some extent, people simply don't have the option to borrow the way they used to.
Economists agree less household debt is a good thing. With fewer loans and credit card debt to pay, Americans are free to start borrowing again to help grow the economy. For Nightly Business Report, I'm Hampton Pearson in Washington.
Small businesses are also doing better. As we mentioned, the markets got a real boost today from the latest survey by the National Federation of Independent Business. The group's Small Business Optimism Index for April rose to its highest level since last October, with a slightly better outlook on hiring and sales.
And here to shed more light on the mood of small business owners is the NFIB's chief economist, Bill Dunkelberg. Bill, welcome. Good to have you with us.
Tyler, thanks. Nice to see you.
Based on the headline numbers in your survey, I would think that you all would be relatively pleased with where things are. The overall index at the highest level, as Susie said, in 6 months, and some of the constituents of it up as well. But your take is notably not that way. Why?
Well, 92.1 is basically 1 point above the average level of the index. The that we've seen since the recovery started back in 2009. So we really haven't gone anywhere. We've really operated in a very narrow range. And of course, going into 2008, the average level of the index was 100 and change. So we're way below the average. And of course, if you look at each of those components, there are 10 components, and you mentioned a few of them. They did improve a lot this time, but they're still very much in recession levels. So we're really looking for a lot more from the small business sector. I mean, it is half of private GDP, and it seems to be stuck in the mud.
Well, you heard David Tepper earlier in the program, and he's saying that, autos are doing well, the economy is doing well, housing is doing well. When you talk to small business owners, what are they telling you, giving you more color about what they're going through?
Well, it is true that housing is doing well. If you look at the construction industry, it's the only industry of our kind of 10 major industry groups where more owners think the economy will be better 6 months from now than think it'll be worse. But everywhere else, we have more owners thinking that 6 months from now the economy will be in worse shape. And so with that kind of a view, you don't get a lot of spending or a lot of hiring. We only have 4% of the owners who think it's a good time to expand. Normally, in an expansion, you'll see 15, 16, 17% who have that view. And that, of course, is where the credit demand isn't. Nobody's borrowing money to do any of these things.
That was one of the interesting parts there. Most people said that their credit needs were being met. They didn't want to borrow. They weren't going to expand. They're a little more optimistic, I guess, than they had been about the conditions 6 months from now. But they're certainly not taking on lots of expenditures to grow or to hire or to raise the wages they pay, right?
That's right. We had a nice 6-point increase in the job creation percentage, but it was an increase from a net zero planning to increase total employment. So that's not good. We have a net 0% planning to add to inventories, so orders aren't going to be going up to those manufacturing firms that would like to produce this stuff. 4% think it's a good time to expand, a terrible number. And we had a 2-point decline in the percent who are making those capital outlays that we would normally finance and that we need to raise worker productivity. So it's still kind of a grim picture. If you look at the profitability of this half of the economy, we're glad that these aren't publicly traded companies because the economy is clearly very bifurcated. The big firms are doing well, record profits, record stock market, but the small firms, they're stuck in the mud.
On that note, we have to leave it. Bill Dunkelberg, thank you very much. He's the chief economist of the NFIB.
Turning now to Market Focus, we begin with Dell and leaks concerning its upcoming earnings report. Dell had planned to release it a week from today, but reports surfaced this morning that profits would come in well below expectations, so that prompted the company to move up its report to Thursday. Dell shares seesawed with the news, closing at $13.47. It was down a fraction. BlackBerry unveiled a new low-cost phone called the Q5, aimed at customers in emerging markets. The company also announced a free version of BlackBerry Messenger that would work with Android and iOS operating systems. But investors were disappointed at news that the rollout of the keyboard-equipped Q10 in the U.S. is being pushed back to June or maybe later. Shares had gained up to the news events, but dropped on that Q10 news, losing almost 4% to $15.25.
Apollo Group led the S&P 500 gainers most of the day, saying its University of Phoenix received word that it was in line now for a 10-year reaffirmation of its accreditation. Apollo shares jumped more than 9% today, and they finished at $20.49 per share on more than double the usual volume. When Angelina Jolie revealed her decision to undergo a double mastectomy today, shares of genetic testing company Myriad Genetics rose to a new high for the year. Myriad's test confirmed that Jolie carried the so-called BRCA gene for breast cancer. Specialists say that for those at risk, insurance will generally cover the $3,000 cost of the test. Myriad shares were up as much as 4% today, also on double the normal volume, before closing at $34.10, up almost 3%. And still ahead, will surging oil production in the U.S. solve our nation's energy problem and lower prices for you at the pump? But first, here's how the international markets did today.
Good news today about energy. There's an oil boom right here in the U.S. The International Energy Agency says a supply shock created by a surge in North American oil production will meet rising demand for energy over the next 5 years. Because of all that, domestic oil, the agency also predicts that OPEC will not have to increase output in the next 5 years. Meanwhile, crude oil fell by almost $1 today, closing at $94 and change.
Our next guest says that energy report is promising. He's John Felmy, chief economist at the American Petroleum Institute. Mr. Felmy, welcome.
Good evening. Thanks for having me.
Do you see, as the IEA sees, a United States that will be energy independent by 2030 and maybe the largest producer of oil, even greater than Saudi Arabia, much sooner than that?
There's no question it can. Between what we can produce in this country, between imports from Canada and biofuels, we can become energy self-sufficient from a North American basis. And that means a lot in terms of energy security, jobs, and revenue for the government.
You know, our viewers might be wondering that if things are so good on the energy front, why aren't we seeing gasoline prices coming down? You know, what's going on there?
Well, it's still a tight world market. While the IEA did reduce their demand growth, it still is growing and it's hitting record levels. And while the U.S. increased its production the most ever, we still haven't seen a lot of additional production worldwide. And so as long as demand continues to grow more than supply, you have a tight market.
Prices are lower at the pump than they were this time a year ago. They are higher, however, than they were just a few weeks ago. Why are prices rising a little bit when the price of crude, as we just said, is actually coming down a little bit?
Well, it has come down in the past couple of days, but prior to that, the price of crude went up about 20 cents a gallon. Ethanol prices went up about 30 cents a gallon, and we moved into the summer gasoline variety that is more expensive to produce.
Tell us a little bit more about supplies getting to the end users. So we're producing a lot more. Do we have the infrastructure, the pipelines, and other necessities to get the oil to where it has to go?
Well, if we're going to expand production by the amount that I just talked about, you're going to need more infrastructure. But you're also going to need more policy that helps in terms of access policy, tax policy, and regulatory policy. So it's going to be a combination of all those three things.
Can we produce, obviously the production of oil from offshore sources, such things as the Keystone Pipeline and the fracking, are very contentious issues in this country among those who favor the production. They say it's a jobs issue, and those, on the other hand, who say there are major environmental risks here. How can we hit the balance right, get the jobs we need, get the natural resources we need, and protect the environment?
Well, the most important thing we can do is educate folks on what the reality of energy is versus the rhetoric. We've had an enormous amount of misinformation campaign against hydraulic fracturing. We've had opposition to the Keystone Pipeline that doesn't make any sense in terms of economics and environment. And so we've got to educate folks on the reality versus rhetoric.
John, let me just go back to that point that Tyler brought up at the very beginning of our conversation, that the U.S. will become more powerful in the world in terms of oil production, producing more oil than Saudi Arabia. What does this do to who's going to be calling the shots from here on? And OPEC, for so many decades, has been dictating the price of oil. Now what happens?
Well, there's no question, all other things equal, increasing supply helps consumers. And of course, when you have a cartel that is composed of 40% of the world oil market, they have a lot of power. If that amount declines significantly, they've got less ability to influence prices. And therein is the change in geopolitics that we referenced at the top of the show. John Felmy, thank you very much. Thanks for having me. John is the chief economist at the API.
And coming up in the program, why honeybees are disappearing and how their declining numbers are threatening parts of our food supply. But first, let's take a look at how commodities, treasuries, and currencies fare today.
Break up Sony? Well, that's what Daniel Loeb wants to do, the activist billionaire founder of the hedge fund Third Point, Sony's largest shareholder, by the way, is proposing that the Japanese conglomerate spin off a stake in its lucrative entertainment division, which includes a top Hollywood movie studio and a music label, in an initial public stock offering. Sony, which, oh, by the way, still does make home electronics and has a finance and insurance division, who knew, said that its businesses are just not for sale. U.S. shares of Sony were higher today.
Loeb has been successful shaking up other tech companies like Yahoo. In fact, he helped bring in its current CEO, and since Marissa Mayer took over last July, Yahoo stock has soared. Tonight, as we continue our week-long series on comeback companies, John Fort takes a look at Yahoo's turnaround and Mayer's role in that revival.
Yahoo. It's one of the defining companies of the internet era, but a year ago, it had nearly fallen apart. It chewed up 4 CEOs in as many years. Search share was dropping. Parking lots took too long to fill in the morning, a sign of flagging morale. And then, new CEO Marissa Mayer came on board. What a difference 10 months makes. New CEO, new game plan, and suddenly Yahoo's a place a lot more people in the Valley want to come to work. Take a look at the homepage. It's been redesigned under Mayer's eye with the hope that users will spend more time there.
People said, give me a reason to come back to Yahoo a few times a day. And now the content's always updating and refreshing.
iPhone apps like Weather have gotten a facelift too. Mayer says that app got more downloads in 5 days than her team had expected for the entire quarter. A main goal of these changes? Make Yahoo cool again. That'll be a long slog. Even users in Silicon Valley know it.
I do get teased about that, yeah, about some people that are more tech savvy, that I don't have, like, Gmail or something else, like almost like Yahoo's a little bit more old-fashioned or something. But it works for me. I mean, I don't.
Investors already seem to be convinced some cool factor is back. The stock's up 70% since Mayer took over. And Matt Kohler, a venture capitalist who is an early employee at Facebook and LinkedIn, says Yahoo's getting back street cred, in large part thanks to Mayer's eye for talent.
I've known Marissa for a long time, and I knew her at Google. And one of the things she always did extremely well at Google, which she's doing at Yahoo too, is building teams and hiring people.
Still, a lot of questions loom ahead. Can Yahoo grow its stagnant ad business? Are investors mostly bidding up the stock, expecting a windfall from Yahoo's investment in Chinese e-commerce giant Alibaba?
The issue here is the stock is moving because people are valuing Alibaba and expecting an IPO to hit later this year or early next year. And the valuations that they're throwing out for this company, I think, are going to prove to be too optimistic.
Maybe, but investors are optimistic about Yahoo. That's something we haven't been able to say for a long time. For Nightly Business Report, I'm John Fort.
And tomorrow we continue our series, Comeback Companies, with a look at insurance giant AIG's turnaround and all the challenges still ahead.
And finally tonight, what's happening to all the honeybees? A surprising drop in the world's honeybee population is raising fears about a real threat to our nation's food supply. Jane Wells has more on what all the buzz is about.
These are California almonds. This is a multi-billion-dollar industry, more dependent on the nation's honeybees than any other business. 60% of all U.S. commercial bee colonies came here this year to pollinate the crop, and it was a challenge.
This is probably one of the most challenging years for the beekeepers to provide the supply of bees that we need. The commercial beekeepers that do commercial pollination were tapped out. I mean, they just had no more bees.
Gordon Wardell is the bee biologist for Paramount Farming Company, the largest grower of California almonds.
See those little mites crawling around on there?
Yeah.
Those are varroa mites. So those are the parasites that are killing our bees today.
Bees pollinate about a third of the fruits and vegetables we eat, $20 to $30 billion worth of food. But last year, nearly a third of the bees died off, much higher than normal, as what's being called colony collapse disorder remains a mystery.
That individual right there is a drone.
Bee expert Eric Musson at UC Davis says beekeepers blame the deaths on many things: parasites, pesticides, the Midwest drought. But most say bees are just plain starving to death. Urbanization and large farms have replaced a lot of traditional bee food.
We've converted much of the lands that used to have some nice food available for bees into places where bees can't find food anymore. So they're just plain short on food.
Queen bees are not living as long as they used to. Adult bees are just more challenged than they ever have been before. It's not one thing.
What to do about it? Well, beekeepers and farmers are starting to work together to plant flowers and other bee food in open spaces. In Europe, they may ban pesticides considered harmful to bees. Bottom line, colonies will rebuild, food will get pollinated. It's just going to take longer, be more difficult, and cost more. For Nightly Business Report, I'm Jane Wells in California's Central Valley.
Of all the things we have to worry about now, there's drought, there's flooding, and now a shortage of honeybees that may affect what we pay for our vegetables and fruits and other
almonds
things.
and stuff like that. I just got to say, Jane, she's the queen bee.
She
I
is
don't know
the
how
queen
she
bee.
did that story.
Lives her life on the bee list.
That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks so much for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everyone, and we'll hope to see you right back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. The Dow rose for the 18th Tuesday in a row after a new survey found small business owners more optimistic about the economy. On Wall Street, that helped the Dow gain 123 points and close at a fresh all-time high. The Nasdaq was up 23, and the S&P added 16 points and reached its own record close. The federal budget deficit is expected to be $200 billion less this year, thanks to higher tax revenues and sequester cuts. Americans are borrowing a lot less money these days, even though we're taking out more student loans. An oil boom here in the U.S. is expected to meet rising energy demand and keep a hold on imports over the next 5 years. And U.S. Airlines collected a record $6 billion in baggage and reservation change fees last year. Be sure to tune into Nightly Business Report right here on your public television station.